What's up guys, it's Chris here. So for the last week or so, I've been doing a bit more traveling. This time to a small little island in the Northern Hemisphere, which some people call the United Kingdom, where I've been visiting some family and taking in some of the sights of the city. But while I've been visiting, I've also been making some big changes to my portfolio, and some of them you might expect and some of them you might not. You may even be surprised by some of the trades I've made, but I'm going to take you through the reasons for all of them and why I think this will help my portfolio to perform even better in 2024 and over the long term to grow my wealth. So basically I sold 3 shares this month for a total of 13,400 Rand, did 2 forex transfers and did 12 new share buys for an amount of 13,100 and another 3,700 Rand that I'll be investing in the next weeks. And in casual cash style, I'll take you through all of them in detail, showing the rands and cents and reasons for them all, including the live share transactions. And at the end of the video, I'll show you an update of my portfolio to see what it looks like now. So let's get started. Well, it's been a busy start to the year, but if you're in the Casual Cash Club, you will have seen all of these transactions that I did on the day that they were made. But let's start off simply. What is our purpose here as investors? Well, I guess you can break it down in essence to one simple thing, which is to get the absolute best returns we can over the long term. So with that goal in mind, let me start by taking you through the shares I sold and why. And it might not be what you think. As you know, my main guiding method in investing is to pick good quality stocks with long-term growth and dividend potential and to dollar cost average into them and hold them over the long term with the potential to hold them forever. Right, so what did I sell then and why? Well, the first 2 shares that I sold are my 10x Core Shares S&P 500 and my Signia FTSE 100 Index Fund ETFs. Now, as you will remember, these are the ETFs that I invested 100 Rand into each and every month, no matter what, for 2 years now. And by doing that method, the returns I got were an 11% return on the FTSE 100 and a 24% return on the S&P 500. So even if you invested 1 million Rand a month instead, I think those are some very good returns, especially in a turbulent market over the last 2 years. In fact, they have often been my very best performing investments in my portfolio. So, with that being said, why on earth would I sell them? Well, don't worry, it might not be for the reason you think, because I still believe that this is probably the best way you can invest, especially if you're a beginner and even as an experienced investor, because the returns are simply brilliant over the long term and almost nothing can beat it. So I'm going to continue to invest in these exact same methods over the long term, just slightly differently. I've been considering doing this for a while now because honestly the 2 ETFs I was using, the 10x Core Shares and the Signia, are actually expensive for what they are. And by that I mean in terms of their management fees, also called the total expense ratio or TER, which is basically what the asset manager, in this case 10x or Signia, charges you every year to manage that ETF. And if you are investing and holding over the next 30, 40 or 50 years, the difference in your fees can make a huge difference to your returns. So let's take a look. The 10x Core Shares S&P 500 charges you 0.38% a year to manage that ETF for you, which doesn't sound like a lot, right? Well, it does when you compare it to the Vanguard S&P 500, which only charges a fee of 0.03%. So that is a staggering 92% reduction in fees. Now, the Vanguard is also an American ETF, so we would invest in dollars. And over the last 30 years, the dollar to the Rand has increased from 3 Rand 50 to 18 Rand 80, or 437%. If you combine those 2 factors over, say, the next 30 years, the difference in wealth creation and returns is astronomical. Then let's look again at the Signia FTSE 100, and they charge an annual fee of 0.88%, and the HSBC FTSE 100 charges a fee of just 0.07%, another 92% reduction in fees, and also a 300% increase in the pound to the Rand over 30 years. Some people have asked in the comments why I don't switch to lower fee ETFs, and they're right. but I was running the ETFs as an experiment on dollar cost averaging, and since we can clearly see it has brilliant results, I think in the new year, it's now time to do the right thing for our long-term investments. So as you might have guessed, we are selling them, but only in order to reinvest them into our existing USA and UK ETFs for some better long-term returns, which is still in line with our long-term investing strategy. Now, keep in mind, these ETFs are still brilliant performers. The 10x Core Shares S&P 500 is still my best performing share in my portfolio. So if you still keep these ETFs, you absolutely cannot go wrong and you will get great returns. For me, I wanted to firstly simplify with one ETF of each, and secondly reduce my fees and take advantage of other currencies. So let's jump into our Easy Equities, and we're going to go to where our ETFs are, and I'm going to go in and sell the shares in my 10x Core Shares S&P 500 for the full amount. And there we go. And I'm going to do the same for my Signia FTSE 100 and go into the share, and once again we're going to sell the full amount here as well, and there we have done that one too. I'm then going to head over to my FTX on Easy Equities or my Forex transfer, and I'm going to transfer the amount of the sale with some extra dividends of about 600 Rand that I had lying around in that account, and send them over in equal parts to the USD account and the GBP account. Then, once the amount's reflected, I headed over to the Vanguard S&P 500 in the USD account, and I put in a purchase order here. Now, keeping with my strategy, I'm going to dollar cost average into this instead of one big purchase. So I'm starting off with $37, and this was about a week ago, and since then I did my second top up a week later for another $38. Now onto our UK account, and when the money arrived from the Forex transfer, I went to the HSBC FTSE 100 and I invested £26 the first week, and then this week I went back in and dollar cost averaged in with another £25. So I still have another 2 purchases each to invest the full amount. And then, as usual, I will keep dollar cost averaging into these 2 index fund ETFs, just like I did with my 100 Rand a month, because it honestly is one of the best ways to build wealth and some passive income from dividends as well. Now, the next sale was for 8,000 Rand, and here I am selling an American stock of mine. But again, we are simplifying and maximizing our returns. So as you know, I have the JP Morgan Equity Premium Income and the Global X Nasdaq 100 Covered Call. And they both do the same thing, which is a call option ETF that doesn't fluctuate a lot in share price and pays really good monthly dividends. But in my last video of the year, I had this to say, but in this year we also made 1,230 Rand income, although the Global X seems to have a better return ratio in both growth and income to the JP Morgan. So it's quite simple here. Because the share price doesn't fluctuate a lot, and clearly the Nasdaq 100 was doing better in both share price returns and dividends, it doesn't make sense to keep both of them. So I went into my USD portfolio and I went on to sell the full amount of my JP Morgan Call ETF. And once that was done, I took that full amount again and I went right back and I invested it straight into the Nasdaq 100 Covered Call ETF. Now, because these ETFs are not meant to fluctuate their share price much at all, I just invested the full amount here because dollar cost averaging won't really apply much here. And again, this is to simplify the portfolio and maximize the returns. I bought both of them and I saw a clear winner in terms of returns over the years I've held them, so I'd rather put my money into the better performer for the long term. Now, that is it for all of the sales. Like I said, in keeping to my investing strategy, I'm just moving to funds with less fees or better returns so that I can make the most out of my money. But let's get into some more of the buys, because I made another 7 buys in the last 2 weeks that we haven't talked about yet. But before we get there, just a reminder that if you want to see these share trades live and in real time as I make them, then you can head on over to the Casual Cash Club on Patreon. These videos don't come out in real time, of course, But even while I'm traveling or doing different types of videos, I'm always updating the Casual Cash Club on the day I do the investments, including the ones in this video, so you can see what I'm investing in and why, or you can go back into the investments playlist and see everything I bought and sold for the last year. And the best part is it's usually $3, but there is a 7-day free trial where you can get access to everything in the club for free. So you can click on the link in the description if you want to check it out. There is also monthly portfolio updates and dividend income and spreadsheets and one-on-one messaging, etc. But you know the deal already. Okay, for the next part, you may have seen in your portfolios that there was some red in the markets recently. Not enough to make a huge impact, but a bit of a dip. And that was because, in part, the UK inflation rate went up by 0.1% from last year, and that caused shares like Lloyds Bank to drop by 13% over a month. Isn't that crazy how 0.1% can cause a jump like that? But of course, it's because inflation is supposed to keep going down from 3.9% and slowly moving to 2%. Instead, it went up from 3.9 to 4%. Now, inflation is still coming down a lot from over 10%, so I took what I thought to be a mismatch of 0.1% change to a 13% drop, and I decided to top up some UK shares. Again, I'm not trying to time the market, I am dollar cost averaging over time, but a dip to me always seems like a good time to do that. So we started with Lloyds, as we mentioned, and we bought in an extra amount of £10. Then we also went to SSE, which experienced a drop of its own, and bought in another £10 here as well. Then we did exactly the same thing with HSBC, where we went in and topped up with £10 here as well. Then onto the USA, where they also saw inflation rise slightly with a 0.3% rise month on month. And again, this affected their markets and specifically their property shares, which I was very happy with because I plan to buy into more property shares this year before interest rates come down, whenever that may be, and I was worried I wouldn't get that value anymore. But on these drops, I was quite happy to buy into some more. So I bought 2 lots of realty income over the last 2 weeks for an amount of $25 at first and then another $20 the week after. I then bought more shares in my Schwab US Equity ETF for $25, and lastly, what I think is great value was to top up my Simon Property Group with another $20, because Realty Income and Simon Property are paying 5.6 and 5.4% dividends respectively, which is brilliant for US property stocks. And that's it, guys. Those are all the 17 transactions I have done in my portfolio for this first month of January. And as I promised, here are the updates and what my portfolio is looking like now. You can pause the screen if you want to look closer. I'm extremely happy that every single one of my investments is in profit, except for one which is a small loss on Lloyds, where we just bought some more. Maybe in the next week we'll have a clean green sweep, but I'm incredibly happy with my portfolio and the results it's giving, along with the dividends it pays on top of all of what you're seeing now. So past performance isn't always an indicator of future performance, but if you want to follow my stock buys and sells, check out the Casual Cash Club for your free 7 days. But guys, that is it for today's video. I hope you enjoyed the portfolio update and some insight into how I am managing my portfolio in 2024 and why I made the changes I did. If you can, please like the video and subscribe if you haven't already. But until then, I'll see you guys next time, as always, on Casual Cash. Cheers.